Hello all, welcome to the world of risk. So, thank you so much, guys, for all the support in the previous video. And it was awesome that we reached a new height in the subscribing. We reached 120 subscribers, so that's a positive sign for us. So, coming back to today's topic, we will be discussing one of the most important topics in the risk management domain, or one of the reformations in the risk management domain, which is asked in most of the interviews, most of the investment banking related interviews. If you go for any regulatory interviews, if you go for any, say, KYC, AML related interviews, so wherever you go, this topic is versatile and this topic is common to all those things. So we are going to check that topic today. So let's get started. So the topic is Dodd-Frank Act. As I told you in the previous lecture that we'll be discussing about this act. So let's get started. So from the past lecture, we know that in 2008 we saw the financial crisis, why it happened and why it was bad and how it happened. So after the crisis happened, there were protests and everything in the Wall Street. People were shouting like arrest the bankers, close the banks, everything. There was a chaos and turmoil. So during that time, the Barack Obama-led government, they came up with one of the legislations, and after revision by Senator Christopher J. Dodd and Representative Barney Frank, this legislation was signed by Barack Obama in July 2020, and these came to known as the Dodd-Frank Act from the names of Christopher J. Dodd and Representative Barney Frank. The official name, however, the long name or the official name is Dodd-Frank Wall Street Reform and Consumer Protection Act. So here is a quick trivia. This act is or this legislation has over 848 pages. So we will quickly summarize what the Dodd-Frank Act really talks about or it means. So the key aspects of the act. So the first thing that the act or the regulation or the legislation focused was on consumer protection, because during the financial crisis, when these big firms failed and there was the banks went bankrupt, the ultimately these were borne by the consumers. So they focused on consumer protection. Next aspect was the financial stability. So these act also made certain changes so that the financial system could be more stable. Then they introduced the regulatory reforms. Then there was another aspect was the transparency. And the last is the whistleblower protection. So we will go ahead and like see what these mean. So like consumer protection is like when this act went ahead and told that yes, from now on there must be stringent rules and regulations where the money of the consumers should not go to waste. During the 2008 financial crisis, when the government bailed out these institutions or the banks, ultimately it was the taxpayers' money that went into bailing out these organizations or financial institutions, and thus this act went with protecting the consumers. Now, in the due course of slide, we'll also see some other as entities that were established under this, which reflects to these aspects. Now, financial stability. This act ensured that banks or financial institutes go ahead with sensible lending and certain other tradings. So they kept a check on the banks and financial institutions. Regulatory reforms. Yes, during this time, there was no checks done, nothing done in the 2008, pre-2008, and loans and everything were given to less credible people or people with no income. Then there was no regulations stating that they need to report anything. So this act introduced these changes in the regulatory reform. Transparency. What does this mean is, after this act was passed, all those financial institutes or the private equity firms or the hedge funds, they need to come clean to the government. They need to report everything. So this is how transparency was like incorporated. Now the whistleblower protection. This is a very big thing that was introduced in the act, and this really helped in the due course of time. Now, what does whistleblower protection means? Like, whistleblower, if anything goes wrong, an entity or a person who tells about that to the authority is known as a whistleblower, basically. So what this act did was, they brought in certain things for whistleblowers. See, as why would you take the risk? Again, going back to our first lecture, why would somebody take risk? Of course, they need to have something in return because it's our human nature. Now, in this act, what it done does was, we got financial incentives placed for whistleblowers. So 10 to 30% of whatever the settlement was done was given to the whistleblowers. So more and more whistleblowers came, and they went ahead with the telling about the malpractices that were happening. The second thing that was there was the confidentiality. The name and everything about the whistleblower was kept confidential. Then there was anti-retaliation. If anyone retaliated against the whistleblower or any actions were taken against the whistleblower, then there would be some consequences. Then we had enhanced reporting, means whistleblowers went through certain reporting mechanisms which were confidential and all, and these things came into play. Now let's go ahead and check. This is one of the important areas because this is something which is asked in the interviews. What were the entities that are created by the Dodd-Frank Act? So the first entity would be, we'd study, is the Financial Stability Oversight Council. So what is this entity? It is an entity born out of the Dodd-Frank Act in 2010. So its goal is to keep banks, funds, these are basically hedge funds, the private equity funds, and companies from becoming too big to fail. Now, what is too big to fail? Too big to fail means when an entity or a company grows very big, so that if it fails, it impacts the economy severely. That is known as a too big to fail company or an entity. So this Stability Oversight Council ensured, or they kept these companies in checks from becoming too big to fail. How did they? They also insisted on keeping more money in hand. Means these banks, everything needed to keep more money so that if there was failure or anything, they could bail themselves out rather than government jumping in and paying with taxpayers' money. Now, this council also had the power to break up these entities. If they became too big to fail, they could break this up so that the impact was less. Now, let's see the next one. So, we had the Consumer Financial Protection Bureau. So, this was also another entity that was created. So, what it does is, it issues regulations and rules that govern consumer financial products and services. So this includes mortgage, credit cards, payday loans, and other financial products. It also supervises financial institutions for compliance with consumer protection laws. So this is basically something which is related to the first point, consumer protection. So this bureau was created to protect the consumers. Consumers can file complaints with this bureau. They will go ahead and look into these complaints and take actions accordingly. They can also regulate these financial institutions. The next thing is that Office of the Financial Research. So what this is another kind of where we went ahead and we saw that we had one more entity that was created. This is known, this what it does is established this was established to improve the quality of financial data available to policymakers. So, during policy making, tons and tons of data is needed. And when if the data is incorrect, the policies are incorrect. So this office was set up, or this research division was set up so that financial data could be uh, there, which was reliable and which could be provided easily to the policymakers and regulators. So this was responsible for basically data collection. Data could be collected from anywhere. They could collect it from the private banks, public banks, from consumers, from regulators, anywhere. Then they did the risk assessment of these, like how risky was the entity or how risky is the policy. So these kind of things they did. They also did the risk monitoring. After they have assessed the risk, high, low, or medium, they will keep on monitoring the risk. And the last is they will support the policy makers by providing them the data, the research needed, and that is how they support the making of policy. Now, the next entity was the Securities and Exchange Commission Office of Credit Rating. So, as we know, SEC was already there. What the Dodd-Frank did was it went ahead and gave powers to the SEC. Now, during the 2008 financial crisis, we know that there were bad loans that were structured into mortgage-backed securities and sold to investors. However, during this time, the credit rating agencies went ahead and gave very good ratings to these bad loans, which attracted investors to invest, and ultimately these loans defaulted. So, what this new office does is they promote accuracy in credit ratings. So they will regulate, basically they regulate the credit rating agencies. So if any credit rating agencies default or say they give wrong information or wrong rating, then they can also lose their license or credibility. So these are its functions basically. What is does is it will oversight and registration, means these rating agencies need to be registered under SEC and they will keep an oversight on this. These office will also place examinations or checks in those credit ratings agencies. They will also make guidelines and rules that needs to be followed while rating certain things. And also they will go ahead and enforce these rules, regulations, or any other things which are necessary so that rating agencies do not go beyond whatever is necessary. Now, the main thing that was created out of the Dodd-Frank Act was the Volcker Rule. Now, the Volcker Rule is a very important rule placed till date within all the financial organizations, and its grasp is increasing. So, what the Volcker Rule aims is to prevent banks from engaging in activities that pose substantial risk to their safety and soundness, or that could lead to conflict of interest. So, what does this mean is those organizations or those financial institutes which accepts depositors money, this rule applies to all those very strictly. So during the 2008 financial crisis, people invested money in the financial institutions, and we hope that these institutions create or save our money in a safe place. But these organizations went ahead and used our money for their personal gains. So this Volcker rule prevents those. It prevents proprietary trading. Now, what does proprietary trading means? The same thing. Using the money, the depositor's money or any other money lent to a financial institute to make their own gains or to use for trading, for making their own gains. So this prohibited proprietary trading unless and until the client or the party specifically mentioned or asked the financial institute to go ahead and trade or do such kind of activities. The next thing was ownership and relationship of hedge funds. So what it did was it kind of like restricted banks, it restricted these financial institutions from sponsoring or owning any hedge fund or private equity funds. So, but again, there is also a catch. there are certain exceptions are present, like if these hedge funds or the what we say, the private equity funds are there to support the say the non-economic communities of the world, then they can go ahead. So certain relaxations are also there. However, it restricted banks from sponsoring and owning hedge funds or private equity funds. Now, this rule is very important for interview purpose in any investment bank or anywhere. So this is asked. Also, the Dodd-Frank Act went ahead and kind of gave the government power to audit the federal emergency loans during the 2008 financial crisis. When the bailing out was happening, the Fed went ahead and provided loans to this financial institute, or this kind of money was pushed in. So this is ultimately the taxpayers' money. So the Dodd-Frank Act gave the government more powers to audit these loans. And now, if any emergency loan is proposed, it should be approved by the Treasury. So this was one of the thing. The one more thing was Dodd-Frank Act also regulated the derivatives market. So here is a like a brief explanation of the Dodd-Frank Act. So do let me know if you need a detailed explanation of Dodd-Frank Act. It's a very big act, so it will take time to explain. And so guys, remember, this is one of the most important rules created, the Volcker Rule. And that's it for today, guys. So once again, thank you all for your support. Please like, share, and subscribe. So this helps me grow, and it also helps me motivate to make more videos on the topics. So please keep on subscribing and sharing. Thank you so much. Our next topic will be types of risk in a organization or a corporate. So we'll be going to cover the types of risk. So that's all for today, guys. Thank you so much. Have a good day.